I welcome you again to Equity Professionals. Today, for financial reporting, we are going to be starting our second topic in our second class. And the second topic for today is conceptual framework. On Monday, is it Monday or Tuesday? Yeah, on Tuesday, we commenced our lectures with regulatory framework, where I explained to you that financial reporting is governed by regulations, and these regulations are the rules and principles that governs reporting. And I call these rules and principles GAP. And those GAP, we said there are three: the National Company Law, the National Accounting Standard, and the Local Stock Exchange Listing Requirements. We mentioned why National Company Law and the Local Stock Exchange Listing Requirement are considered as GAP. It's because, for example, in the company law, like the CAMA 2020, there are sections that teaches us how we issue and redeem share capital. And there are also sections that tells us about the types of share capital. Without this information, we would not be able to prepare financial reports completely. Therefore, that has an input in the financial statement. Also is BOFIA, which provides rules for bank. BOFA requires banks to make certain reserves in their financial statements. So it also has an input into the financial statement as well as the tax law. Thereafter, we looked at the local stock exchange listing requirements, which is usually issued by SEC for companies that want to get listed or companies that are listed on the stock market. It contains a list of documents and reports they're expected to continuously provide to SEC. And finally, the main one, which we said is going to be our focus, the National Accounting Standard. We mentioned that the accounting standard we use in Nigeria is the IFRS or the IAS. We mentioned that our focus for financing is to understand accounting standards majorly. So that's GAP. Then we explain the differences between rules and principles, that they are not the same. Thereafter, we got on to principle-based framework and rule-based framework. Eventually, we agreed that IFRS is a principle-based framework because it only gives a general guide and it provides a foundation for chain of reasoning. Whereas company law and local stock exchange listing requirements are rule-based. Therefore, we can conclude that the regulatory framework adopted in Nigeria is a mixture of principle-based framework and a rule-based framework. While the IFRS is principle-based, the other items of GAP are rule-based. In some other countries like the United States, it's completely rule-based. But we here is a mixture of it. But don't forget, IFRS is a principle-based reporting framework. Then we proceeded to looking at the regulatory body that develops these rules and principles. And these rules and principles I'm talking about now going forward is the IFRS. In Nigeria, is the Financial Reporting Council of Nigeria that is responsible for enforcing compliance with IFRS. And this body is headed by Dr. Rabiu Olowo, who is the MD right now. And I explained to you that this FRCN was enacted in 2011 with a key objective. And that objective is to protect the interest of investors and other stakeholders. From that singular objective, then they strive to achieve their other objective from providing guidance on issues relating to financial reporting and corporate governance to ensuring that companies have good corporate governance practices in place, to ensuring that financial reports are accurate and reliable, to ensuring that there is harmonization between professional bodies and other institutions that have an input into the financial report, and ensuring that there is high quality of service among auditors and professionals. And ultimately, all these would help them enhance the credibility of financial report. All these are objectives of the FRCN. You have to know this. Then I told you that the FRCN do not develop IFRS. They are not the one that developed it. What they did in 2011 was to adopt it. Whom did they adopt it from? It's from an IFRS Foundation three-tier structure. These guys came from the UK, and this three-tier structure is in such a way that they have a standard setting board of experts, whom are the IASB and the ISSB. You see, the IASB has been delegated with the task of developing IFRS, while the ISSB has the responsibility to develop IFRS sustainability disclosure standards. That's beyond the scope here. We are not going to talk about that. But the ISB develops IFRS. However, they have boss, they have Oga, who is the IFRS Foundation. It's the IFRS Foundation that has given them that responsibility that you as my employees, have given you the responsibility to develop IFRS. But the mandate, the people carrying the mandate to develop IFRS is the IFRS Foundation. And the members of the IFRS Foundation, they call them the trustees. And these trustees are people that have representation in every continent, in Africa, in Asia, Australia, Antarctica, South America, Europe. I mean, they are well diverse, that their international competence is intact. Now, the IFRS Foundation has 4 key objectives: to develop a single high-quality global accounting standard in public interest, to promote the rigorous application and use of this standard, to take care of the need of SMEs and emerging economies, and to ensure convergence of national and international standards. And the East IFRS Foundation, they also report to the monitoring board. And the aim of that monitoring board is just to ensure that there is a formal link between what is happening in reality, the markets, the capital markets, and whatever it is they are doing within that structure. Whatever it is those guys developing standards are doing. The monitoring board is just there to ensure that they are actually doing what the market wants. And that's why the members in the monitoring board are capital market authorities. And when I say capital market authorities, for example, in Nigeria, the capital market authority is SEC, Securities and Exchange Commission. So imagine a SEC being in charge of those developing standards for companies to adopt. SEC, being the regulator for publicly quoted entity, they understand their reporting need. They understand what shareholders want. And that is why I think the monitoring board has a very best or a good fit of members that are there. So we looked at it critically last week. These are the guys behind IFRS. Then we went further to look at how IFRS is developed, from this step 1, which is agenda consultation, to step 2, which is the research program, to step 3, which is the standard setting program, to step 4, which is the maintenance program. And finally, we looked at the need for regulation. And we said without regulation, you cannot enforce compliance. Without regulation, users might be misled by management. Without regulation, accounting, similar items might not be treated in a similar way. We looked at all of those. And to wrap up the class on Tuesday, We also look at some past questions I can have asked in the past. The recording of that class is going to be shared with you. From next week, I guess, we'll start putting all the recordings on YouTube, and it will be shared privately to you via your email, and things would go on smoothly from there. Okay, so I have just summarized what we did last week. I intentionally did that, right? And the process of passing this ICANN exam starts now. If you cannot summarize it the way I've summarized it as at now, then that means you need to double up. I mean, when you're taught a topic, you must be able to sit down and write a summary down yourself. Like sit down and do a summary. Okay, this is what I understand from this topic. So any parts that you forgot, is either you go and check your soft copy note or you go and watch the video again. I mean, you have all the resources you need available to you. Point is this, you need to have an high-level view of every topic we teach you. Now, today we move forward. Now, today we are looking at conceptual framework. So a conceptual framework is a statement of generally accepted theoretical principle which forms the frame of reference for financial reporting. What does that even mean? When we say statement of generally accepted theoretical principle, it's very similar to GAAP. I mean, that's what they are saying here, that it's GAAP. Yes, they are not wrong. The only thing is that the conceptual framework is a step above the GAAP in the sense that the conceptual framework is a statement of generally accepted theoretical principle which forms the frame of reference for financial reporting. In the sense that when you want to develop that GAAP itself, those regulatory body that develops GAAP, when they want to develop them, they usually refer the conceptual framework. Developing those GAAP is the conceptual framework. So that's why they said that it forms a frame of reference for financial reporting. Therefore, the conceptual framework provides the basis for the development of new accounting standards and the evaluation of those already in existence. So that's what I was saying, that the conceptual framework is the tool, is what provides the basis for developing accounting standard. So when I explain to you that what we want to learn in this class is all about accounting standard, now you are knowing that when the IASB wants to develop those accounting standard, the basis they use, the guide that they use to develop those standards is the conceptual framework. Or if they want to amend an existing standard or evaluate an existing standard, is the conceptual framework that they use. So the conceptual framework is just like what a forest is to the furniture most of us are sitting on right now. So if you see the accounting standard as the finished furniture, then see the conceptual framework as a forest where those wood were obtained from. You can also see the conceptual framework like a blueprint of a house. If you want to build a house, you will need a template, you will need a blueprint. And with that blueprint, you can easily build your house. And if a lot of people use that same blueprint, you'll find out that people would have, or those that use that blueprint or that architectural plan, so to say, would have houses that look the same in terms of structure, right? In terms of outward structure, the way those houses will look. That is what the conceptual framework does. And that is why by the time you pick up any accounting standard, you'll find out that their structure is the same. Their structure is the same. All accounting standard, they will be talking about definition, they will define the items, they'll be talking about recognition, they'll be talking about measurement and disclosure. And not only that, their pattern with which they recommend recognition is mostly the same. For assets, it's mostly the same. For liabilities, it's mostly the same. And also is measurement. The measurement they recommend is mostly the same in all standards. And that's because we have a singular source from which we develop those standards. From which you develop those standards. So what will now be different? Imagine myself and maybe two of you guys in this class now, we use the same architectural plan to build our house. Our house will be the same. So the only thing that will be different is maybe the color I decide to paint my house and the interior, right? The type of my interior generally, my chairs, the furnitures I will use inside my house, like that. And that's how it is for conceptual framework. So that's the introduction to conceptual framework. So now we can easily pick up advantages of conceptual framework. And the very first and the very visible one is that the process of development of accounting standard will be standardized and coherent. Will be standardized and coherent. So we won't just, it will be the same way in all cases. We won't be doing maybe patchwork basis. Before we know what we want to do from start to finish. And there won't be any political interference when developing standard. No one would interfere because we have the basis for developing standards. We have it. And also, users and preparers of financial statements will understand that accounting practice and accounting standard are based on common ideology. They would see that we are not just doing things the way we want. We have a common ideology. And ultimately, it's going to provide guidance for unusual transaction, which may otherwise be open to different interpretation among user groups. So by the time we have a transaction that there is no standard for, remember I told you that when there are transactions that there is no standard for, the IFRS interpretation committee will come up with an interpretation. They don't just sit down and just come up. They use, this is what they use. The conceptual framework is what guides them to provide those interpretation on those unusual transactions. Now, the disadvantages is that, I mean, having a singular guide for developing standards and considering the fact that we have variety of users, so can it really meet the need of those variety of users? I mean, it's a downside. It could be a downside. And again, does this conceptual framework really makes the work of developing accounting standards or implementing it any easier? It could be a downside. I mean, we need to just come up with some disadvantages. Now, what's the purpose? Now, it depends on whom or who is using this conceptual framework. For the IASB, they use it to develop standards and also to amend or update standards. Again, the ISB will also use it in their convergence or harmonization of national and international standards. Again, national standard setting bodies can also use it to develop their own local standards. Management of companies or preparers of financial statements would use it in applying. We use it to understand the IFRS better. Again, the preparers will also use it to develop consistent accounting policies, especially areas where there are no standard that applies to a transaction and there is need for an accounting policy. At this point, this point 5 is a bit beyond us right now because I've not actually taught you what an accounting policy is. So later you are going to learn in IAS 8 accounting policy that we develop accounting policy from accounting standards, right? So when we want to develop a policy on a transaction that we don't have a standard on, so it will be difficult. So in that case, the conceptual framework will come handy for the preparers, but you understand it better as we move forward. Another one is users. Users that want to interpret and understand the financial statement. The conceptual framework will also help those ones to do that as well. It will also assist the auditor in forming an opinion, okay, and also in complying with the IFRS. And anybody who is interested in understanding how the IASB develops accounting standard, the conceptual framework would also help. And of course, it will also help the IFRS Interpretation Committee in developing interpretations on IFRS and new transactions and events. Okay. Keep in mind that the conceptual framework is not an accounting standard, and it does not override the requirements of an existing standard. The conceptual framework only helps to develop those standards. So occasionally, if there is a conflict between the accounting standard and the conceptual framework, listen, is the requirement of the accounting standard that will override, not the conceptual framework. Please note that. Okay, so that's the first part of this class, introducing what a conceptual framework is. So let's look at some quizzes just to be sure that you're not sleeping. Since this is theory, I cannot be the only one talking. So let's look at quiz 1. It says that which of the following best describes a conceptual framework? A, statement of gap. B, accounting concepts. C, accounting principles. D, basis of accounting.
Statement of gap.
Statement of gap.
That's
Statement
correct.
of gap, yeah.
I agree. Number 2, when there is a conflict between an accounting standard and a conceptual framework, which one will override? Is it accounting standard?
Okay.
That's correct, accounting standard.
Standard, yes.
Correct. Number 3, the conceptual framework can help the treatment of unusual transactions. True or false?
Oh,
True.
True, yes.
that?
Number four, the answer is true. Yes, it can help. Number 4, which of the following is not a purpose of the ISB's conceptual framework? Which of the following is not a purpose of the conceptual framework? A, to assist the ISB in the preparation and review of IFRS, to assist auditors in forming opinion, to assist in determining of items covered, to be authoritative where specific IFRS conflicts with the conceptual framework.
To be authoritative.
Correct. Okay, so good. That means you were following. Okay, let's mute again. Now, the content of the conceptual framework. This conceptual framework I'm teaching you was last updated in 2018. So we want to discuss the 2018 conceptual framework. So let me just go straight to it. So now the 2018 conceptual framework is organized into chapters. So as a financial reporting student, you have to know these chapters. Not like I can ask you what is chapter 2 or what is chapter 1, really. You just need to know what they are, which I will go into soon. So chapter 1 talks about the objective of general purpose financial reporting. Chapter 2 talks about qualitative characteristics of useful financial information. Chapter 3 talks about financial statement and the reporting entity. Chapter 4 talks about the elements of financial statements. Chapter 5 talks about recognition and derecognition. Chapter 6 talks about measurement. Chapter 7 talks about presentation and disclosure. Chapter 8 talks about concept of capital and capital maintenance. Okay, so this is the conceptual framework you're looking at in front of you. And this content is what guides or provide the guidance when developing IFRS. So let's pick them one by one. So chapter 1, this talks about the objective of a general purpose financial reporting. I mean, it's as straightforward as what is the objective of financial reports? And is here. The conceptual framework states that the objective of a financial report is to provide financial information about the report entity that is useful to existing and potential investors, lenders, and other creditors in making decisions about providing resources to the entity. You have to know this, right? You have to know these two sentence or one sentence objective. So let's break it down. It says to provide financial information. So we need to know what financial information is it providing about the reporting entity. So chapter 3 talks about reporting entity. So I would leave what a reporting entity is to chapter 3. That is useful to existing and potential investors, lenders, and other creditors. So this naming of 3 set of people has actually directed preparers or developers of standards on whom they should focus on when they are preparing their report. And it's these 3 sets of people: existing and potential investors, lenders, and other creditors. Focus on those 3 people. And you would agree with me that it's not just these 3 people that are the users of financial statements. There are other users, like the government, like the public, like the tax authority, the international community, employees, and a lot of other users as well. But this conceptual framework is saying that these are the 3 people that we are preparing or providing financial information for. That's noted. And these 3 sets of people, they will then use those information in making decisions about providing resources to the entity. Now, I will use this definition to explain chapter 1. So the first thing that captures my attention is the fact that they mention these 3 people. So the 2018 conceptual framework has therefore introduced the primary users of financial reports. I kind of asked it before, that who are the primary users of a financial report? You have to mention these 3 people: existing and potential investors, lenders, and other creditors. Without wasting our time, right? Because we don't have so much of it. The reason why these are the focused people is because they are the one that provides the risk capital to the business. Without an investor, there won't be any business without the banks. Who are the lenders? A lot of business will have not been able to consummate key transactions with which they don't have available resources to do. So lenders have been very critical in providing risk capital, and also other creditors like the suppliers. The suppliers are also very important because they give trade credits. They are so important that they will give you goods and say, when you sell, come and pay me. Who is more important than that? And that is why the focus of provision of financial information is on these three set of people. Having mentioned that, they said that then they would then use that information we give to them in making decision. I kind of asked it before that what decision are these primary users making? It's straightforward. The investor will simply want to make a decision on whether they should buy or sell your shares because they have invested in the shares of that company. The major decision the guy wants to make is whether he should buy more or whether he should sell. That's the decision. Okay, so whether you are making profits, that one is not a decision. That one is just on the basis of, okay, is what they will see. So based on what they see, right, they will now make a decision. So what they are seeing in your books is not the decision that, okay, whether you are liquid or whether you have assets, whether you have liability. No, no. Those are the information. But the decision they want to make is, should I buy your shares or should I just sell your shares, depending on what they are saying. The lenders also, ultimately, they want to make a decision on whether they should give you borrowings or whether they should not provide loans to you. Majorly, can you settle their loans? Those are the decisions they want to make. No, this guy cannot settle. I'm not going to give him loan. Those are the decisions he wants to make. And the creditor will also make decision around whether he should provide trade credit to you or not. So you will see from their nomenclature, you can easily know the decision they want to make. And also because the investors, who are mostly the shareholders, also vote during annual general meeting. So they also make decision on voting or whether they should influence management decision or not, because they have the power to do that. They have asked it before, so I think it's something you should be able to figure out in the exam because it's kind of logical. And finally, from this is, they said they provide financial information. Then what financial information are we providing? The conceptual framework states that the financial information are three. Number one is the economic resources of the entity. When we say economic resources of the entity, we are talking assets. So financial report provides information about assets. The second is claims against the entity, as liabilities. So we'll provide information about our liabilities and changes in the entity's economic resources and claim. So this information around our assets, our income and expenses. Our income and expenses. I kind of asked it before that according to the conceptual framework, what financial information do we provide to the primary users? Don't go and say statement of profit or loss, statement of financial position. No, that's just the component of a financial statement. The information you actually provide is just information around your assets. So if you remember economic resources of the entity, which is assets, claims against the entity, and changes in the entity's economic claims. Okay. And that is it for chapter 1. And the last thing I want to mention is that, you see, when providing information about these asset, liabilities, income, and expenses, They are provided using accrual basis of accounting. They are provided using accrual basis of accounting. Because in accounting, we have two bases. Is that you are providing your information to users using cash basis, or you are providing it using accrual basis. So those ones that uses cash basis, which of course we don't use in IFRS, are those that you only record sales, like when you collect money. So if you sell and the person hasn't paid, or you haven't received money from that customer, you won't record it. You won't record it as sales. Or if you make an expenditure and you haven't made payments, you won't record it as expenses yet. So those are cash basis. But that's different in accrual basis. Accrual basis is saying that as soon as the transaction occurs, recognize it in your books. We don't deal with flow of cash. Rather, we focus on the transaction. So they recognize income when it is earned. When it is earned. Earned in the sense that you have done the work. You have provided the service. Earned. So recognize it as income, even if you have not received money. Recognize it. So recognize income when it is earned, not when money is received. And recognize expenses when they are incurred and not when cash is paid. And you have incurred an expense when you have enjoyed the service. Somebody has provided service to you. You should put it in your books that you have incurred an expense, not until you pay. So you just recognize it and acknowledge the fact that, okay, I'm owing. Like, I'm owing. So that's accrual basis, and that's the basis with which we present and provide financial information to the primary users. Okay. So I think I've spoken for like another 10 or 15 minutes. So quizzes. So quiz one. The conceptual framework makes it clear that financial information should be prepared using cash accounting, accrual accounting, all of the above.
Accrual accounting.
Okay, that's correct. Which of the following is the financial information provided by an entity according to the conceptual framework? Statement of financial position, statement of profit or loss, claims against the entity, all of the above.
Claims against the entity.
That's correct. 3, which of the following is a user of
Statement of financial position.
No, the answer is claims against the entity. And the answer is claims against the entity. So number 3, which of the following is a user of financial information according to the conceptual framework? A, government, B, lenders.
Lender.
Okay, that's correct. You guys are hot. Okay, good. Let's go to chapter 2. So you can mute now. Now, chapter 2 talks about the qualitative characteristics of useful financial information. And these qualitative characteristics is what gives an understanding of what can make the financial information useful to users. That whatever information you are providing, before it can be useful, then it needs to have certain characteristics. These characteristics can either be fundamental characteristics or enhancing characteristics. The fundamental qualitative characteristics is what distinguish useful financial information from information that is not useful. So the key thing here is this. If your information has fundamental characteristics, then it is useful. If it does not have it, then it is not useful. So fundamental is the ultimate. Is either you have it or you don't have it. If you have it, then it is useful. If you don't, then that means that report is misleading. That means if FRCN should get hold of it, you'll be in trouble. The second one is enhancing qualitative characteristics. So, as the name implies, it will only make it more useful or less useful. So, if the financial information has these characteristics, it's more useful. If it doesn't have it, it's less useful. What are these fundamental characteristics? There are two: relevance and faithful representation. Relevance and faithful representation. So when is a financial information said to be relevant? It's relevant if it is capable of making a difference in the decision that is made by user. Then it is relevant. If it is capable of making a difference in the decision that is made by user. So when we say capable of making a difference, it speaks volume, because that means it is what dictates the kind of decision you are going to make. And here is saying that it's capable of making a difference if it has predictive value and also confirmatory value. If it has predictive value and confirmatory value. So just learn that as we move on in our study, you will see how financial statement has predictive value. How it's, you know that financial statement is historical, and we prepare it in such a way that users can use it to make decisions. They can use it to predict that this company will be profitable. No, let me sell my shares. This company is not good. Look at when you pick up any financial, I just want to give you scenarios where these historical financial statements have predictive value or how they ensure they have predictive value. One scenario is that every financial statement must have at least 2 years. That is the current year and the immediately preceding period. The aim of that is just so that it can have predictive value. Because where there are trends, where there is trend, last year this guy made 10 million. This year he made 11 million. So you can easily predict that, okay, he's improving, he will get better. So predictive value. And another one is that if, for example, now there is a one-off material item, like let's say you sold one of your assets. You sold one of your assets. You now made either a loss or a profit on that sale. Highest one will say that you must present it separately. You must present that kind of item separately so that somebody can easily see that this profit is one-off. It might not reoccur next year. So it's enhancing predictability of that historical information. Another one is there is a standard called IFRS 5. That is when you plan to discontinue or you plan to sell an asset. IFRS 5 will say that present that item as non-current asset held for sale. So somebody looking at it, will see, this guy wants to sell these assets. They will go to the note and see which assets. So somebody can easily predict and know that this guy might be facing some issues or what have you. When GSK was going to leave Nigeria early this year, a lot of people, the news was all over. But the reality is that people have not been reading financial statements. If you have been reading, you should have known that GSK was going to leave because it was already clear from their financial statement from 2016. It was there. They were already divesting from almost over 400 employees in 2016. In 2017, it came down to 50 something. In 2018, it came down to only under 10. I mean, it's clear there that these people are leaving and they were having discontinued operations in their books. They were having non-current asset held for sale. It's clear that these guys are leaving the country. So reading financial statements should, for it must be relevant. It must have predictive value. And it must also have confirmatory value. Confirmatory value is kind of straightforward in the sense that those historical information that you can use to predict. So in the future, we should be able to confirm whether you are wrong or not on your confirmations. And another important thing that really affects relevance is something we call materiality. So there is no way you can talk about relevance in reporting that an item makes a difference is materiality. So, and when we say materiality in reporting, it means that that item, if you omit it or if you misstate it, it will change the entire dynamics of the decision the user wants to make. It will change everything entirely. So materiality is extremely important when we are talking about decision of users or when we are talking about relevance. So if you omit a material item, it could render that financial statement irrelevant. So materiality and relevance goes hand in hand. So relevance is a fundamental characteristics. The next one is faithful representation. So faithful representation simply means that the reports generally phenomena, that is transactions in words and number. So you have to ensure that these numbers and words, you present them faithfully. You'd present your economic activities the way they are. Don't lie. If your revenue is 50 million, say that is 50 million. Don't misrepresent. Don't lie. Don't overstate. Don't understate. So that faithful representation, present your words and your numbers faithfully, the way they are. And you would only do that if the information you provide is complete, if it is neutral, and if it is free from error, then you would have faithfully represented. And when we say your information is complete, it means that all your transactions, all the information that the user needs to understand the transaction, you include it in the financial statement. Include all the calculations, all the explanations, let everything be there. And you have to be neutral. Neutral in the sense that don't manipulate the financial statements. Don't be biased in your presentation, in your selection. Neutral, like present it the way it is. Don't manipulate it. And when we are talking about neutrality, then that can only happen if you are prudent. So they introduce prudence, right? So when we talk about an accountant is prudent, we are not saying that you don't spend money. That's not what prudence means. Prudence is just that simply means don't overstate your income, because don't overstate or understate your income. Don't overstate or understate your assets. So be prudent. I mean, if you are expecting 1 million, that you would sell 1 million, Prudence in the sense that be sure that that 1 million will enter before you go and incur it or go and put it in your books that you are going to make 1 million. No, you have to be sure. There must have been some things or documents you must have collected that they will now not come back at you and say that you cannot make this revenue again. You as an accountant, if you are not sure that you make this money, don't put it in your books. And if you check most accounting standards, especially that on revenue, it addresses this very well, following this guidance on prudence. So don't overstate or understate your assets, liabilities, income, and expenses. And that's what prudence concept is talking about. And it's strengthening neutrality here. And finally, for faithful representation is free from error. So your financial information can only be faithfully represented if it is free from error. And what I mean by free from error is that there should not be error when you are describing those transactions. I mean, there should not be error on any omission when you are describing the transaction or in the process of preparing your financial information. There should not be error or omission there. So when I say free from error, I'm not saying that the figures must be accurate, because in reporting, our figures cannot be accurate because we make use of a lot of estimates, a lot of judgments, which you will see very soon. So it cannot be accurate. So we're not free from error here does not mean free from inaccuracies. No. What free from error here means is that when you are describing, meaning that the way you classify your expenses or income, let it be free from error, or the process, like your double entry, don't go and debit what you should credit like that. That's what we are talking about, free from error, not accuracy in figures. No, it's not possible. Okay, so speaking about making estimates, making judgments, yes, we do that in reporting, but you have to put it under check. Otherwise, your financial report will become irrelevant, will not be useful, will not be faithfully represented. So that's what we call measurement uncertainty. So the level of measurement uncertainty means that in reporting, we are acknowledging the fact that, yes, we make use of judgments, we make use of estimates, that our figures is not an exact depiction, is not precise. We estimate. Fine. That's measure, meaning that there is an element of measurement uncertainty. Our measurement is uncertain, is not accurate, is not precise. Fine. Okay, that's measurement uncertainty. But you need to watch it in such a way that when you are making those judgments, don't make unreasonable judgments or estimates. I mean, all your judgment and estimates should be backed up by data, should be backed up by calculations, should be backed up by models. That's why IAS 1, when I teach you IAS 1, it specifically mentioned that all estimates and judgment that you have made, you must list them under this heading of measurement uncertainty in the books. So a proper financial report, there will be an aspect of measurement uncertainty. So they will list areas where they believe that they have made high level of measurement uncertainty and low level of measurement uncertainty. So when your measurement uncertainty is too high, then it becomes a problem. Let the user know so that they will not solely rely on that in making decision. Okay, so I hope I've communicated measurement uncertainty to a large extent. Okay, and there's another term under faithful representation called substance over form. Substance over form is not a separate qualitative characteristics, but it is implied in faithful representation, in the sense that if your information is not presented in accordance with substance over form, then you cannot faithfully represent. It's not possible. So substance over form is what makes you faithfully represent, right? And when we say substance over form, in fact, they usually put it as economic substance over legal form. I mentioned economic substance yesterday partially, but what it means by an example is that um, what I have here is that is the party that is enjoying economic benefit from an asset that recognizes it in his books and not the owner of the asset. That's just one of the examples. You see, a better example is leases. You asset, for example, now. Yes, the asset is you have rented it. So that asset that you have leased, you can put that asset in your books as your asset, even though it is not your own. Because that asset, you are using it to generate money. You are using it to generate economic benefit, even though you have listed it. So the new standard on IFRS 16 relies on this principle of substance over form and now allows all businesses that whenever you lease an asset, that asset, you can recognize it in your books as if it's your asset. Like put it in your book as an asset so that users can see what is making this money for you. That's one example of substance over form. Another example, let me leave asset alone. Another example is you sell goods. You sell an item to a customer, right? You have collected money from the customer. But this item, you say you sold it, but you are still using the item. You did not you did not give the item to the owner. You're the one still using it. You said you said you have sold it, but you're still using it. So if you want to report the economic activity, the financial reality of that transaction or the economic substance, what we can see is that, guy, you are still using these assets. You did not sell it. So you cannot recognize that kind of sales as sales. It should not be sales. But rather, if that person has given you money, if that person gives you money for the so-called sales, in fact, that money you collected, you would recognize it as a loan. It's like the guy has just given you a loan and used the asset as collateral. That's economic substance. And you'll be seeing this. I'm just giving you some fast forward examples. So by the time we start studying accounting standards, then you'll be seeing that, oh yes, this is reporting the economic substance and not the legal form. So our focus in reporting is not contracts, is not legal. No, we are focused on the transaction. What is happening? What is that? What is the transaction here? Okay, so that's faithful representation. So those two are powerful, and I can like asking them. They want you to explain them. They have asked substance over form as separate definition that explain it and whatever. Now, the second one is substance over form. Sorry, enhancing characteristics. Okay, so before I move to enhancing characteristics, so Damilola is asking a question that can the use of an exchange rate that like the USD qualify as measurement uncertainty, considering that we have different exchange rates in the country? Okay, so that is not measurement uncertainty. It's not measurement uncertainty. Do you know why? So measurement uncertainty would be things that there are no data from, like external or third-party data. Exchange rates, the data is everywhere. Everybody knows the black market rate today. Everybody knows the official exchange rate today. So you can, in fact, if you go on Google and ask, okay, what's the exchange rate of Naira to dollar in March 2023? Google will tell you. So you are not making any estimates. So estimates here would happen, for example, when you want to calculate depreciation, for example, now. So you would usually use, okay, the useful life of the assets to calculate it. There is no scientific way of determining the useful life of an asset. It's an estimate. Nobody can specifically tell you that, okay, this is how we determine the useful life of an asset. Or when you want to determine whether an asset has impaired, for example, now. Okay, when you want to determine whether an asset has impaired, so there are certain indicators we look at. Those things are estimates because it's not so, there are no third-party data that somebody can verify. Okay, so those are areas of estimates in reporting. So using exchange rates to determine the Naira value of a foreign currency transaction would not come in as measurement uncertainty. I hope I answered your question. Okay, so enhancing qualitative characteristics, there are 4 of them. 1 is comparability, 2 is verifiability, 3 is timeliness, and 4 is understandability. So these ones, like I've mentioned earlier, they are not so serious in the sense that they only make it more useful or less useful, right? So even if your financial statement does not have it, it will just be less useful. It doesn't mean it's not useful. Okay, so it's the fundamental that's the ultimate. But this one just makes it more useful or less useful. So now, the first one is comparability. As the name implies, which means that you should be able to compare your current year figure with last year, right? And even with other entities' financial statements. We should be able to do that comparison, okay? And the only way that can be done is where you have applied accounting treatments consistently, and of course, when you have disclosed accounting policies. That is the only way we can achieve this objective or these characteristics. Consistency. So this consistency and this other one, disclosure of accounting policies, they are actually under comparability. They are what makes comparability possible. Another enhancing characteristics is verifiability, which means that we should be able to verify those figures. And what does that mean? It means that if you say that the value of your asset is 20 Naira, the way you must have presented that 20 Naira, if a professional picks up that account or that information, they should be able to recalculate it. Meaning somewhere they should be able to see, okay, what was the cost? When did you buy it? What was the depreciation you used? What was the basis of your depreciation? And all of that. All those things should be there. That they should be able to also recalculate that your figure and get something similar. So verifiability is just speaking to, you should provide sufficient information in your books so that it will be verifiable. Like independent observers or knowledgeable user can recalculate your depiction, your figures, and get something similar to it. Okay, if they cannot recalculate it, then it's not verifiable. You should provide all those data you have used, all your workings, all your models. Show it. Then that is when it becomes verifiable. Another one is timeliness. It's as the name implies, provide it when we need it. You must meet all the regulatory deadlines. If your account is not ready as a bank, and you know CBN wants to see your account before the end of March, or you are in any other company, any company, your account is not ready, and you know you need to file returns to FIRS before the end of June or 6 months after your year end, or you are a listed entity, you know SEC wants to see your reports at the end of each quarter, you know they need quarterly report from you. So all of these things are also key. And finally is understandability, which means that this report should be easy, it should be concise for users to understand it or to read it. And please note something here for understandability. So when we say users should understand it, we are not saying just any user. We are talking about knowledgeable user, like users that are diligent or that has made efforts in understanding the report. So the users we're actually talking about are professional accountants, right? It's not just because you're a shareholder, you think you're a user. No. As a shareholder, go and employ an accountant to interpret the financial reports to you, right? So when we say understandable, we are talking about users that have reasonable business and accounting knowledge, and who is ready and willing to diligently study the financial reports. So somebody like that should not pick it and not understand it. Like he picks revenue, he cannot find the notes to the account, or he cannot find the basis. Or he sees your depreciation, he doesn't know how many years, what was the depreciation rate, all of that are not there. So you need to make it understandable to people like that. So this is chapter 2, and that's the qualitative characteristics of a useful financial report. And note that, you see, in meeting these characteristics, you must ensure that the benefits outweighs the costs. So all these things I'm mentioning is not for just any company. It's for companies that has investors, that has lenders, that has other creditor. If you are the one that is funding your business and you are saying that IFRS, understandability, company, it doesn't concern you because you don't have any primary user. So we are talking about people that is worth their while, that the benefits justify the costs. Because to get a professional that would do all of this for you is expensive. It is very expensive. Very. Okay. So I've been speaking for almost 20 minutes. It's time for you to get involved. So quizzes. So brace up. This one is more difficult than the one we have looked at before. So number 1, comparability is identified as an enhancing qualitative characteristics in the conceptual framework for financial reporting. Which of the following does not improve comparability? A, restating the financial statement of previous years when there has been a change of accounting policy. B, prohibiting changes of accounting policy unless required by an IFRS or to give more relevant and reliable information. C, disclosing continued operations in financial statements. D, applying entity's current accounting policy to a transaction which an entity has not engaged in before. Yep. Let's see who will get this one.
Disclosing discontinued operations.
Okay.
Restating the financial statement
Of previous years where there has been a change in accounting policy. No, this is not the answer. So this actually improves comparability. So when I teach you IAS 8, I will tell you that when there is a change in accounting policy, you should apply it retrospectively, meaning that you should go and apply that policy from previous years. It's for comparability so that we'll be able to compare like with like. So A is not the answer. And somebody says,
Disclosing discounted Disclosing discontinued operations.
Okay, so now this closing discontinued operation is not the answer because
Applying
Prohibiting changes of
this
accounting
correct
policy.
accounting policy to transaction which an entity has not engaged in before.
yes, that's the answer. The answer is actually D. The answer is
Yes.
not B. The answer is not B because this actually enhances comparability. When you prohibit changes in accounting policy, unless required by an IFRS, because when you are changing accounting policy anyhow, it's not good because it's accounting policy you use in determining your figures. So we want you to be consistent with your accounting policy. So we don't want you to change it. So prohibiting it is improving comparability. And C is also the answer because when you disclose discontinued operations, it fosters comparability because people would now, because disclosing it means that you would separate continuing from discontinuing so that you can compare like with like. So the answer is actually D. When you want to apply current policy to a transaction you have not engaged in before, no, that's wrong. You need to understand that transaction and know which policy to adopt. Okay, so you see that was a bit tricky and advanced. So the second one, faithful representation is a fundamental characteristic of a useful information within IASB conceptual framework. Which of the following accounting criteria correctly applies the principle of faithful representation? Okay, which of these correctly applies it? A, reporting a transaction based on its legal status rather than its economic substance. B,
No.
excluding a subsidiary from consolidation because its activities are not compatible with those of the rest of the group. C, recording the whole of the net proceeds from the issue of a loan, which is potentially convertible to equity shares as debt. Okay, so you are recognizing everything as debt. So allocating part of the sales proceeds of a motor vehicle to interest received, even though it was sold at 0%. Yes. So what?
Allocating part of the
Allocating part of sales proceeds.
sales proceed of a
D.
motor vehicle to interest received even though it was sold with 0%.
Wow, that's correct. How?
That one looks dubious.
How are you correct? Impressive. Very impressed. So, yeah. So that's the answer. And you will learn this better that because when you sell
That's all.
when you sell a motor vehicle, right, especially if you receive the money, right? You receive the money, or let's say you sold a motor vehicle and you received the money. Let's say you did not release the motor vehicle. So there could be some instances whereby there could be some financing elements in that sales transaction. There could be some financing elements there. So not in all cases, but in cases whereby the person gives you money or did not get the assets. So in that case, you might have to recognize the fact that you are earning interest. Like you have, are you really earning interest? Or maybe the person has not actually paid you. Maybe you sold, so the right analogy would be that you sold the motor vehicle to, let's say I sold it to Deborah and she hasn't paid me, right? I sold it to her and she has not paid. So that means she's owing me money. So IFRS requires that I should see the fact that she's owing me, like I've loaned her some money. And I should, even though she's not going to pay interest, but I should still recognize interest in my books, like interest received. So that's faithful representation, that's economic substance of a transaction. So yes, this last one correctly applies the principle of faithful representation. So all these other three does not correctly apply it. So as we move on in our study, we are going to get exposed to most of these things, and hopefully they would help. So let's move forward. Number 3, financial statement represents transactions in words and numbers. To be useful, financial information must represent faithfully this transaction in terms of how they are reported. Which of the following accounting treatments would be an example of faithful representation? A, charging the rental payment for an item of plant to the statement of profit or loss where the rental agreement meets the criteria for a finance lease, including a convertible loan note in equity on the basis that the holders are likely to choose the equity options on conversion. C, the recognizing factored trade receivables sold without recourse. D, treating redeemable preference shares as part of equity in the statement of financial position. Let me see if you can get this one too with luck.
Advanced one.
Any guess? Which of the
A.
following accounting treatment will be an example of? What do you say?
A.
A, you are charging for an item. No. So when you have finance lease, you don't put the rent, the rental income in POL for a finance lease.
Okay, D.
C.
Treating redeemable preference
Is B.
as part of equity in the
The
statement of
recognition.
Is D.
No, the answer is not
is
D. The answer is
C.
not
The
D.
answer is B. B.
Okay, so first, let me tell you why the answer is not D, right? So redeemable preference shares are preference shares that you pay back. So you would pay them back their money. So anyone that you have to pay back its money is a liability. That means you are owing it. So when you're now treating it as part of equity, that's wrong. So you cannot
okay.
treat shares as part of equity. B is not the answer, right? And the reason is that when you include a convertible loan note in equity on the basis that the holders are likely to choose equity option, you cannot assume, because when you say a convertible loan, is either the person converts or he does not convert. So we usually separate it into equity and debt. You will learn that in IAS 32. So you cannot put it as part of equity. So no, the answer is actually C.
Yes, I got it.
Recognizing a trade receivable sold without recourse. And I had somebody mention
I
it.
got it. Yeah.
So when you have a trade receivable that you have factored and the factor cannot come back to you that, okay, I was unable to collect the money. Please, can you give me back the money I used to buy these receivables? If the guy cannot come back at you and come and claim his money, do you recognize that receivables from your books? Do you recognize it? So you will learn this also under financial instruments. So that's faithful representation. Okay, so a simpler one is this. Which of the following is not a fundamental characteristics identified in the conceptual framework? Faithful representation, relevance, materiality, reliability.
Reliability.
That's correct.
Reliability.
Yeah, that's correct. And finally, in accordance with the ISB's conceptual framework, which qualitative characteristics assumes that users have a reasonable knowledge of business and a willingness to study information with reasonable diligence? Relevant?
Understandability.
Understandability.
Understandability. That's perfectly correct. Okay. You guys are actually very smart. So is these ones that are direct that were just giving us a little tough time. The ones that are straightforward, you can easily obtain. Okay, so let's mute again and let's go another 5 minutes. So chapter 3. So this chapter 2, in this topic, 90% of the time, whenever ICANN wants to ask this topic, is chapter 2 they usually ask. So that chapter 2 is extremely important for us. So please, when you are reading conceptual framework, remember that chapter 2 is the most important part of it in terms of frequency or at with which I can have asked them in the past. Okay, so chapter 3 talks about financial statement and the reporting entity. So this one is quite short because we just need to understand again what's the objective of financial statement and what a reporting entity is. So this chapter talks about that's again that the objective of financial statement is to provide information about assets, liabilities, equity, income, and expense that is useful to users to assess future cash flow and assessing management stewardship and all of that. Okay, so that's one. Number two is it also explains to us what a reporting entity is. Remember, in chapter 1, we mentioned that the objective of a financial report is to provide financial information about reporting entity. See a reporting entity, we are talking about an entity that is required or chooses to prepare financial statements. So those ones that are listed on a public market, like the Nigerian stock market, those ones are required to. While other companies, right, might not be required to. Okay, but most companies that must file returns to with FIRS, you need to provide, they will ask you for your audited accounts. So those ones too are required to. But some companies that are not even filing returns, are not doing all of that, and that just choose to, they are also reporting entity. So all forms of business, whether you are a sole proprietorship business, those ones now, they don't have to file returns with FIRS, right? Because they are either sole proprietorship business, whether a partnership business, whether a company, you are a reporting entity, okay? So a reporting entity can be either a single entity or it could be a group of entity. And like I've mentioned, it does not necessarily have to be a legal entity. Okay, so that's a reporting entity. Just have a picture of it in your mind that when we talk about entity in as far as IFRS is concerned, we are talking about all forms of business. So don't see an entity, don't picture an entity as a company. No, it could be a sole proprietorship business, it could be a partnership business, then a company as well. Then reporting period. I mean, everybody knows what a reporting period is. The period over which you prepare accounts. Okay. So we could see reporting period as either current period or even comparative or previous periods. And if you are making predictions or forecasts, reporting period might also be future periods, but that is not applicable for now. So reporting period is just the current period and previous periods, right? And again, chapter 3 talks about perspective adopted in financial statements and the going concern assumption. So when we are preparing financial statements, we are saying that prepare it from the perspective of the reporting entity. This is just emphasizing the fact that report the transactions of the entity, don't report financial statement from the perspective of an investor that maybe because of what the investor wants to see. No, what you report is what is happening to the entity. You provide information about a reporting entity to those investors. So the perspective adopted in financial statement is about the reporting entity. I think that's quite straightforward. And again, when you are preparing those information, prepare it on the assumption that the entity will continue to operate into the foreseeable future. And they don't have plans to liquidate. And finally is consolidated and unconsolidated financial statements. So here, chapter 3 is saying that consolidated financial statement is better. So if you have subsidiaries and you have to prepare consolidated financial statements, so it's emphasizing the fact that it's better that you prepare consolidated than not for you to, that you should. It is better than unconsolidated, really. So that's all chapter 3 is talking about. It's just these terminologies. ICANN has never asked this before. So just know them. Know what a reporting entity is, note what a reporting period is, know going concern. Okay, yes, they have asked going concern assumption. That you should explain going concern assumption, right? So, and remember that consolidated financial statement is preferable to unconsolidated. Chapter 4, this talks about the elements of financial statements: assets, liabilities, equity, income, and expense. As a matter of fact, this is all we want to learn in financial report. So assets, it says here that an asset is a present economic resource controlled by the entity as a result of past events. And an economic resource is a right that has the potential to produce economic benefits. So when we talk about an asset generally, fundamentally, it has to be present. For you to even mention that you have an asset, you must have acquired it. So present. So an economic resource, that's what an asset is, economic resource. So it went in the second sentence to explain what an economic resource is. That is a right that has the potential to produce economic benefits. So you understanding an economic resource is just thinking about what makes money for you. So potential to produce economic benefits, we are talking about what will make money for you. What will make money for you? So whether it's going to decrease your liability or it will bring in cash flow, it will bring in sales, anything that makes money for you is an economic resource. So they didn't say something you see. So don't see an asset as necessarily something you can see or touch. No, it doesn't have to be tangible, right? It's a right. Anytime you have that right, and that right has the potential to produce economic benefits, whether you can see it or not, we don't care. Is it making money for you? If the answer is yes, it's an asset. So an asset is a present economic resource. So economic resource, something that makes money for you, controlled by the entity. So that economic resource, you must control it. And this control means that that money is making comes to you. If it's not coming to you, then you don't have control. You have control if the money comes to you. So as a result of past events, meaning you must have acquired that asset in the past. That's an asset. There are several examples. So you'll get tired of examples before we finish this class about an asset. So just understand what that definition is talking about. I've never seen a question that asks you to define this, but it's not a bad idea knowing this definition. So liability is a present obligation of the entity to transfer economic resource as a result of past events. So a present obligation, present, before you can say you have a liability, it must exist, right? And it's an obligation. You see, in reporting here, it's the conceptual framework further explain what an obligation is. It says an obligation is an action, okay, in which an entity has no practical ability to avoid. Okay, is like your responsibility to act in a certain manner, and you cannot avoid it. Like you must do it. You cannot. It's just like taxes, for example. Now they will come after you. It's just like you want to build a house and you have to pay government permits. You cannot. So anything that you cannot avoid is what we are terming as obligation. So if you can avoid it, then it's not a liability. So it's your responsibility to act in a certain manner which you have no practical ability to avoid. And this obligation that you cannot avoid will require the entity to transfer economic resource. So I can make this as simple as anything that takes out money from you, right? Because your economic resource is what brings in money. So anything that takes out that money from you is a liability that will make you transfer economic resource is a liability. Okay? Businesses, you cannot do away with that because we expect that for you to have a liability, you must have one way or the other created value for you, then you need to pay back, stuff like that. So that's a liability, present obligation of the entity to transfer economic resource. Then we have equity. So equity is the residual interest in the asset of an entity after deducting all its liability. So the key word here is the residual interest. So when we say somebody has an interest in the assets, that can have an interest in an asset of a company. First is the owner of that company. Who are the shareholders? So meaning that whenever those assets make money, those that share that money, okay, are those that have interest in the assets. So like the shareholders, and also if you have liabilities, they also have an interest because you need to pay them their returns on the money you have borrowed, and also you need to pay them back their money. Okay. But where the interest is residual, in the sense that the money or the cash flow you make from that asset, where there is a particular person that you settle last, like you consider him last, then that's a residual interest. And those are people we call equity. And a typical example of equity is ordinary shares. Ordinary shares. So usually they will add ordinary shares to reserves to get equity. But the idea of equity is residual interest in the asset. Of course, after deducting all liabilities. Then income. Of course, that money you are making from your asset is income. So that's why income is an increase in assets. So that increase in the assets is income. Decrease in liabilities. When your liability is decreasing by whatever reason, maybe somebody forgave you some liabilities or they say don't pay, government gives you tax holiday, is an income that results in increase in equity. Okay? So when your equity increases, it's an income. However, equity is share capital. So when you say increase in share capital, it could be additional capital. So you cannot say additional capital is income. However, that's why they now said other than those relating to contributions from holders of equity claims, which is additional capital. So additional capital is not an income. That is not the increase in equity we are talking about here. The increase in equity we are talking about here is profits, gain. Okay? Because what increases your equity or capital is either you are making profits or there is additional capital. That's what will increase your equity. So what we are talking about here is profit or gains. That's the income we are referring to here. Finally, is expenses. It's just the reverse of income. So it's decrease in assets, increase in liabilities that result in decrease in equity, other than those relating to distributions to holders of equity claims. So that decrease in your assets, anything decreasing your assets, that decrease is an expense. Increase in liabilities is an expense, right? Because by the time you're incurring expense, it increases your liability, rent, you want to pay salary, it increases your liability, okay? So that results in increase in equity, sorry, decrease in equity. So expense will decrease your equity, okay? So decrease in equity can never be reduction in share capital. CAMA does not allow reduction in share capital. So you are not even thinking about that. So what we could be thinking about here is dividend. Okay, dividend can also decrease your equity in terms of reduction in your retained earnings or profit. So dividend is not an expense. So that's why they said other than those relating to distributions to holders of equity claim. So distributions to holders of equity claim is dividend paid. Okay, so dividend paid to shareholders is not an expense, it's an appropriation of profit. That's why when we learn IAS 1 next week, you'll find out that dividend paid, you won't find it in P&L. Where you will find it is in the statement of changes in equity. Okay, because it is not decrease in equity. So the decrease in equity we are referring to here are losses. Loss is the decrease in equity we are talking about here. Okay, so it won't be a bad idea knowing these definitions by heart. I mean, these are the foundation of all the things we want to learn in reporting. I find out that a lot of our students makes that fundamental mistake. They don't read these parts. They will not read it. So when I start teaching them all this standardized, when I'll be reading, they will leave the foundation alone. They don't even know it. They will not be struggling with that one. Especially when we now start teaching you group account. They will not say, I want to read group account. And this foundation is much more important than any topic I'll be teaching you later. So please go and sit down and read this so well. After this class, I will immediately share the notes. So you read it. So all the things I've been explaining, I actually have it explained here in these notes. So all those explanations I've given is in these notes. Okay, so I've been talking for almost 20 minutes. Now let's look at these quizzes here. I hope everybody is not sleeping. So we'll find out very soon. So in accordance with ISBs, the Conceptual Framework for Financial Reporting, what is the definition of income? Okay, let me just look for increase. So the answer is between C or D. So what's the answer?
Increase in assets, decrease in liabilities.
Okay.
C.
Other than that, result is increase in
It's C,
equity, other
sir.
than
The answer
those
is C.
relating to contributions.
C.
Answer is C.
Yeah, I agree. The answer is C. So number 2, Winner PLC has purchased the patent for 20,000. Okay, so I have to mute her. Okay, so Winner PLC has purchased a patent for 20,000. The patent gives the company sole use of a particular manufacturing process, which will save 3,000 a year for the next 5 years. What element of financial statement is this patent?
Assets.
Sorry?
Assets.
That's correct.
Assets.
That's correct. That's
Assets.
correct. That's perfectly correct. So number 3, Ade Limited paid Wisebaba 10,000 to set up a car repair shop on condition that priority treatment is given to cars from Ade Limited. What element of financial statement is this 10,000 to a day limited? Asset, liabilities, income, equity, expense.
Equity.
Liability.
It's an asset.
Okay, so I have equity, liability, assets,
Expense.
expense. Expense is the right answer.
Expense, yes.
Expense is the answer, but I'm actually curious. Why did you say expense? Because you're correct. Can you explain?
Okay, since according to what you mentioned earlier, he is not obligated per se to give priority to Ade Limited. Like Ade
Fantastic,
Limited doesn't have control over him.
fantastic, 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 fantastic. That's correct. Yeah. So it's not an asset to Ade because it doesn't have control. And it's not a liability to Ade. Ade doesn't even, obviously does not have a liability here. So it's not income, it's not equity. It can't be equity now because it's not like he has interest in his asset. Doesn't have interest in assets here. So what Ade Limited has done, he has just gifted we save about 10,000. And he's just saying that, okay, you could give me priority treatment if I bring the car on condition that. So he's an expense to Ade. So number 4, let me mix that question. So number 4, Truthful Limited provides a warranty with every car sold. What element of financial statement is the warranty?
Liability.
That's correct.
Liability.
Liability. Okay. I think this diet I have very smart set of students. Okay. Chapter 5, recognition and derecognition. So this one is quite straightforward. So here, chapter 5 is saying that, okay, recognition. And recognition is a two way of saying recording. Okay. So it's actually the process of capturing for inclusion in the statement of financial position or profit or loss, right? So record is as good as recording. However, you can only record those elements we just mentioned earlier. And you can only record them when they meet the definition we mentioned earlier. So that's the criteria for recognition, right? When they meet the definition. However, so an asset or a liability should be recognized if it is relevant and provide the users of financial statement with faithful representation of the transaction of the entity. So from what I'm seeing here, if the examiner wakes up one day and asks you, what's the criteria for recognition of elements into the financial statement? From what I'm seeing here, there are 2 criteria. Number 1 is that the items must meet the definition of one of the elements of financial statement, whether asset, liability, equity, whatever. And number 2 is that it must meet the fundamental qualitative characteristics, which is relevant and faithful representation. That item must be relevant and it must be faithfully represented. So I need you to note those 2 recognition criteria because that's a core thing here. Secondly is derecognition, which is the removal of all of parts of
Hello,
a
sir.
Yes, my brother.
Can you please restate that 2 criteria?
Recognition criteria. Okay. So number 1, the criteria for derecognizing items or elements from the financial statement. Number 1, the item must meet the definition of one of the elements of financial statements. It must meet the definition of one of the elements of financial statements is here. That definition is here, number 1. Number 2, it must meet the fundamental qualitative characteristics of relevance and faithful representation. Which is this? It must meet the fundamental qualitative characteristics of relevance and faithful representation. It must meet the fundamental qualitative characteristics of relevance and faithful representation.
Thank you, sir.
You're welcome. Okay, so the recognition is removal of all of or part of these items from the financial statement. Okay, so the recognition would occur when the item no longer meets the definition of either an asset or a liability. Okay, so if the examiner asks you in the exam that, okay, state the recognition criteria in the conceptual framework, you can give them these 2 points. Number one, where there is loss of control of an asset. Number two, where the entity no longer has an obligation for a liability. Okay, so it means it's the same thing as it no longer meets the definition, but this one is more sexy. Where there is loss of control of all or part of the recognized assets, or where the entity no longer has obligation for a liability. So those are the recognition criteria. And that's chapter 5. So this one is straightforward. So I intentionally did not put any quizzes here because there is not so much here for us. So I believe we have all gotten recognition and the recognition. So let's go to chapter 6. Chapter 6 talks about measurements. So elements that are recognized in the financial statement are quantified in monetary terms. And quantifying in monetary terms means that you must select a measurement basis. Okay, so there are different measurement bases that we have. Two majorly. There's historical cost and there's current value. Those are the two measurement bases we have. Historical cost, current value. So historical cost is the price paid for an asset or for the event which gave rise to a liability, and the historical cost does not change. So historical cost works in such a way that in your books is the price you have acquired an asset that you will continue to carry that asset in your books. So, and that's what we use even to tomorrow. That's how accounts are prepared. So in such a way that if you buy an asset in 2020, let's say 2021, and this is 2024, when you check the financials, you will still be seeing the cost of that asset in the books. Though they will remove depreciation, but that cost is still there in the books. So that's historical cost. Right? If you choose to use historical cost, fine. However, now there's another way, which is current value. So this is also the price you would pay for an asset or the event that gave rise to a liability. But with current value, those prices will be updated to reflect any change since it was acquired. So that's where current value differs from historical cost. For historical cost, the price does not change. It depends on when you bought it. Okay, so and a major issue with historical cost is that you now find out that in your books you now be finding a mixture of a very old cost and recent costs because it depends on when you actually buy it. So you find out that a Corolla that somebody bought in 2010, in the books the cost is 1.2 million. Somebody now buy the same Corolla that somebody has used for 10 years in 2024. It's even 14 years. You now buy it for 4 million. Yeah. Fortunately, that's the reality now. So, and that 4 million right now is historical cost. Okay. So historical cost works with when you bought it and it doesn't change. But current value, yes, it's initially recognized at the price you bought it, but they will be updating it to reflect changes in the environment like that. So an asset that you bought in 2010 for 1.2 million, by the time people they see that the prices of this asset have gone up, they would increase it in the books and update it to the current price. That's current value. And we find out that most standards they are developing now is trying to reflect this, so which is okay, so which is good. So when we talk about this current value now, so it depends on what is happening to the assets. So if you intend to sell an asset, right? If your intention is that, okay, you want to sell this asset, then, and you want to maintain current value, then that value is called fair value. Okay, so that means you measure it at fair value if you have intention of actually selling the assets. So, and that's why a fair value is the price that would be received to sell or pay to transfer a liability in an orderly transaction between market participants at the measurement date. You know this definition. I've never seen an ICANN exam ask you to define this, but that's fair value. So fair value is just similar to the revaluation amount of an asset, or how much am I settling my liability today. So it's like an exit price for fair value. So for you to use fair value, you are looking at exiting that asset or liability. So this is a type of current value. So current value is not actually a thing. So current value is either fair value, value in use, or current cost. So value in use is where you want to continue to use the assets, right? So you would use value in use. There are situations where value in use are applicable, especially in IAS 36 when you want to get impairment loss. So that's the only instance where you find out that we use value in use in reporting. So, and it's usually the present value of future cash flows. The present value of future cash flows. So usually they will estimate future cash flows, like how much this asset is going to earn in the next 4 or 5 years. Then they will get a discount rate, discount it to present value. Then that gives the value in use. You would see it. So for now, it's just for you to have the idea that, okay, there's a value, a measurement basis called value in use, and is obtainable when an entity has the intention of continuing to use an asset, and it's usually the present value. Okay, it's the present value of cash flows. And the final one is current costs. Okay, so current cost is similar to historical cost, but the difference is that the current cost will now be changing. So that one will just be monitoring continuously the current cost. It's just like knowing the replacement cost of an asset. Okay, so if you want to adopt current cost, so every year you know if I want to replace this asset, how much is it now? So that is the value you'll be carrying it in your books, current cost. Okay, so that is measurement basis that we have in reporting. So you would make use of these a lot. Now let's look at some questions. All this explanation I'm giving is here. So let's look at 2 questions here. Number 1, in accordance with IASB, the conceptual framework for financial reporting, which of the following is not a measurement basis? A, current cost. B, present value.
Present
C,
value.
that's correct, present value. Second one, which of the following criticism does not apply to historical costs, financial statements during a period of rising prices? which of the following does not apply? They are difficult to verify because transactions could have happened many years ago. They contain mixed values. Some items are at current value, while some are out of date value. They understate asset, they overstate gearing.
The answer is A.
Fantastic. That's correct. The answer is A. This A does not apply because it's easy to verify historical costs. So this does not apply to historical costs at all. You can verify because you know how much you bought it. Historical cost does not change. It's the easiest to verify. But all of these ones apply. Yes, historical cost is mixed value, like I've explained. There are some, depending on when you bought it, some will be current value, some will be out of date. Historical cost will understate your assets. Like you bought an asset, a Corolla in 2010 for 1.2 million. Now it is almost 5 million. And you are still keeping it in your books at 1.2 million. You're understating your asset. And you could even overstate your profit because you'll be recognizing a very small expense in form of depreciation and what have you. And it's because you are understating your assets, it makes your liability higher. So your gearing level, your liability will now look higher than your assets. So your business will look geared. By the time your liability is so much, that means you are highly geared, meaning you are using so much liability to finance your operations. That's how it's going to look like. So all of these other three applies except this one, because historical costs can be easily verified. Now, moving to the close of this class, this one is a very short one. Presentation and disclosure. We have already passed the main ones. So this one is majorly saying that all of these elements that you have recognized, you have measured, then you need to present it in some statements and make some disclosures. Then here it talks about certain principles of disclosures, like you should classify assets that are similar together. You should avoid unnecessary details. You should avoid standardized approach. So it's just encouraging entity to use a tailor-made approach to presentation. Don't use a boilerplate approach. Yeah. So ultimately, the most important part of this chapter is saying that income and expenses would be recognized in P&L. Okay. Income and expenses are recognized in P&L. Why other income arising from changes in the value, changes in value of an asset or liability. Okay. Changes in values of asset or liability would take those ones to other comprehensive income, especially when it comes to valuation of non-current assets. So like if you are using current value and the value of your assets is increasing maybe as a result of inflation or like what is happening in Nigeria, you see that gain, that increase in value of an asset is a gain that we regard as unrealized gain, and we believe it should be recognized in the other comprehensive income. The only unrealized gain that we usually take to P&L is the one arising from foreign currency balances. So if you have loan in foreign currency now, and exchange rate moves in your favor or against you, and maybe the naira value increased or decreased, so that one you can put them in P&L because this is money, just that it's in a foreign currency, but it's money, so it's realized. But when it comes to paying on non-current assets or non-financial assets, those ones, take them to P&L. Take them to P&L because those ones, we know that before you can realize those gains, you must sell that asset first. And it's not easy to sell an asset. Before you even sell itself, that gain you made might have even reversed and become a loss. So it depends on the volatility of the economic environment you're operating in. So all those kind of items go to other comprehensive income. And in this class, the major one we are going to learn here for financial reporting is revaluation surplus. Okay, I'm not going to teach you IAS 21 that deals with changes in foreign exchange rates. It's beyond the scope here. So, and some other items that go to OCI, but the only one I will teach you is revaluation surplus. It goes to OCI, changes in the value of an asset. And finally is that, you see, when I say unrealized gain, an unrealized gain can become realized, especially when you now eventually sell that asset, and that gain, you then have it in money, then that gain becomes realized. So we expect that then you then take it out from OCI and take it to POL. Okay, that's a natural thing to do. However, because of the dynamics of when you would eventually sell it, it could be after many years. Okay, so for evaluation surplus, it doesn't get transferred to POL. It gets transferred to retained earnings directly. I know I'm speaking jargons right now, but you would get that. The main point I want you to understand right here is that income and expenses go to P&L, right? Unrealized gains, like evaluation surplus, go to other comprehensive income. While, you see, when other comprehensive income becomes, or even unrealized gain become realized, they are recycled, meaning they are transferred to your OCI. They are transferred to your OCI. Okay, so the final chapter is chapter 8. Intentionally, I'm going to leave chapter 8 to next week. I'm going to take it as part of IAS 1. I'll take chapter 8 and IAS 1 together intentionally because I know you should be tired by now. I've been talking for over 2 hours. That's a lot. No calculation, just talking and talking and talking. So I'm going to close the class for today. And so again, my name is Wasu. I'm not the only lecturer that will be taking you financial reporting. I have a colleague of mine that would support me in taking it. He is not available today. He should take you today, but believe me, he's going to be joining us next week. You'll be meeting him. He's a fantastic lecturer. I'm sure you enjoy his classes. So we are going to take you through all the syllabus. Believe me, we are covering the syllabus 100%. So we'll take it all through and let's see where that takes us. So I have done 10%. I'm just assuming that I've done chapter 8 because it's not much. I've done 10% of your syllabus. Again, from experience, I find out that students don't read this topic. They just undermine it. And it's a huge mistake because this is the foundation of everything I'll be teaching you. If I were you, I would go and sit down and read this very well. Students that pass easily are those that start reading from day one, and anything they don't understand, they go over it again first, like over and over again. Then if you still don't understand, then you then ask third parties, your friends, and I'm sure your colleagues, you have smart people in the class. And from what I'm hearing from you guys are smart. So this is a virtual class, mind you, but I think you guys should find a way of coming together. That group should not just be a fancy group. Whatever it is you are reading on your own, you have questions, you can post it on the group. Me, I will intentionally keep quiet. I will not answer because I want fellow students to answer. Make that group a communication group. Help yourself. Don't keep your reading to yourself. Let's make that group active. It's not a group where it is only me that will be posting. No, it's a group for you. Post questions. I mean, make it interactive, but don't ever post anything that has nothing to do with reporting there. Is anything financial reporting, post it there. If you have an article you think will help us, post it there. If you have questions you want your fellow students to solve, post it there. Let's discuss. So from there, I'm sure people will recognize people that are participating more. People will reach out to you for assistance. You make friends. Then everybody will pass. constructive and good friends anyways. So the aim again is that none of you should fail. As of today, I have 21 students sitting in this class. All of you must pass. That's our first objective. And please, to do that, go and read topic 1 and topic 2. I'm going to drop these notes immediately on the group. And very importantly, we are giving you 2 weeks grace to pay up. Week 1 is gone. Tomorrow, week 1 gone. Next week, we'll still allow you, we'll send notes. But from upper week, we'll be sending notes and meeting invites through other means to only paying students. So I would strongly advise that even if you cannot pay all your money, at least pay a part that will give you access for like another 2 weeks to the end of the month, and where you will now then be required to have settled up. But don't miss any class. Try as much as you can not to miss. But luckily for you, even if you miss, it will be recorded. I guarantee you, it's not easy to sit down and listen to 2 hours recorded class when it's not that you are watching everything, or when it's not that you are watching Netflix and chill. This Wasil talking is so boring. So it's just ultimate that you sit in this class and participate as much as you can. And this is going to be my pattern. I talk, I give you quizzes so that just to be sure that you are following. And so far, so good. You guys have been impressive. I appreciate you guys for your attention and your patience. I would see you next week. Thank you very much and have a wonderful night. Bye.
Hello, sir.
Thank you, sir.
Hello,
Good
sir.
night.
Yes,
Thank you.
ma'am.
Good night.
Good night.